topic again, okay, in details. So let's start. See this. Firstly, everyone, those who have joined means joined this batch fresh, or those who have come for the CIB first time. Look at this. There are four papers. Okay, ABM, BFM, ABFM, and BRBL. Okay. Then these are the modules. You can pause the video and read these modules again. Electives, rural, HR, IT, central and risks. Negative marking has been removed as of now. As of now. Okay. There are some subjective questions. Subjective means you have to put the answers, input. Now this time May 23, IIBF has started a new scheme under which you have to input the answers. These answers are not given any options. No options are given. No options. So this is a new term introduced by the IIBF in this May exam. Okay. So that's why, yeah. Yeah. Test series was not uploaded in my account. Okay. Sure. Rogrinth. What I'll do is I'll give you the contact numbers, okay, of all the admin guys. Those who are having any issues, you can directly contact these admins. Okay, I'll just give you. Hold on. Yeah, this one. Because here, I won't be the right person over here to resolve the queries right now, isn't it? These are all the admin issues are handled by the admins. Here, I've pinned it in the comment. Okay, pinned up. So Rogrinth, you can just see the numbers and contact them. Okay. Anyone has any technical issue, you can directly contact it on these numbers. Save it for your future also means these next 4, 5, 6 months, whatever we are here. So save it for the same. So let's move on. Yeah. So no options would be given to certain questions. Now rural, HR, IT, central banking and risk management. These are the electives which you have. Okay. So remember, whenever you are having these electives, select that elective in which you can get at least 20 marks without reading. Without reading, 20 marks. Then only select that elective. You should be conversant with that elective, confident with that elective. Okay? Chalo, move on. Today's topic which I will be taking is ratio analysis. Now this again will be taking when we start the regular course. Okay, this is the part of actually module C of your ABM. Okay, so I'll be taking it at that time also. Today is just the first part for because many of you are new and we have to do the revision also, and some of them are watching on the YouTube also. So for them, we have taken this batch for them as well as for, it's a sort of revision because this forms the base of your ABM. So ratio analysis, remember, under ratio analysis, we have two types of ratios. Okay, two types. Which are those two types? One is this traditional ratios and second is this functional ratios. Nowadays, we hardly use these traditional ratios. We don't use it now. Okay, so let me show you over here. So we don't use these traditional ratios now. We use all these functional ratios. Okay. Why? Because in your banking also you might have seen now that the jobs, the profiles, the roles, they hardly matter nowadays. What function somebody does, it depends on that. So the world has changed from the traditional or the this basically category wise. From there, it has shifted to what work somebody does. So that's why traditional is just for your studies, balance sheet, P&L and composite. Composite means these ratios combine balance sheet as well as P&L ratios. So they won't be asked in the exam. What will be asked in the exam is this functional ratios. Remember, yeah, this is everything will be started again. Yeah. Afterwards, everything will be started again. Correct. Things will be started again, Neelam. Yeah. So functional. Profitability. See here, there are three types of functional ratios. One is this profitability, second is this solvency, and third is this turnover ratios. Profitability, solvency, and turnover. Okay. Now, how to remember these? These ratios are a bit difficult to remember, I would say. But there is a way to remember. We had that cards game. Cards. Do you remember that cards game? In our childhood, we used to play. Even now, we might be playing. That is called as 5-3-2. 30 cards in that, and then you have to make five hands, then three hands, two hands, like that, right? So similarly, you have to remember this: five over here, three over here turnover, and two over here solvency. So these are the ratios. This way, it becomes easy for you to remember. 5-3-2, right? So 5-3-2 means five ratios in profitability, three ratios in turnover, and two ratios in solvency. What are these five ratios in profitability? We'll be dealing in one by one, each one. So what are the five ratios here? Out of these five ratios, again I'll give you. Firstly, I'll read out the names: operating, EPS, PE, gross profit, and net profit. So these are the five ratios. Now, the point over here is how to remember these five ratios. Here, it is a combination. EPS and PE, together they form one group. Gross profit and net profit, together they form one group. So there are only two groups now. And last one is operating, that is separate. Some books write this ratio as operating and some books write it as overall profitability. That is also correct. Overall profitability. Okay. So operating profit or overall profit. Actually, the meanings of these two are separate, altogether different. Operating profit is different, overall profit is different. Some books give this as overall, some books give this as operating profit. But generally, in your CIIB book, it's given as operating profit. Okay. So these are the five ratios for profitability: operating, EPS, PE, gross profit, and net profit. You hear this ratio of PE, those who are investing in shares, okay, or those who watch the channels, okay, mean business channels. You might be hearing these ratios: PE ratio, price to earning, then EPS. We hear these two ratios. These two are common: gross and net profit. Okay. Then the next part is solvency. Solvency means there are two ratios. There are two types of solvency ratios. One is short term, second is long term. Again, each one is divided into again two parts: current and liquid, that is one, and DSCR and ICR, that is two. So these are all short term liquidity ratios. Next is long term. Long term means what? Debt equity and fixed assets ratio. So these are long term solvency ratios. Then comes turnover. In turnover, what you remember, there are three only: inventory, debtor, and debtor period. If you remember these three: inventory turnover ratio, debtor turnover ratio, and debtor period, then the remaining two, creditor and creditor period, you can automatically remember creditor turnover and creditor period because it is same as debtor turnover and debtor period. So you have to remember only this basic concept: 5-3-2. Five ratios for profitability, three for turnover, and two for solvency. All your ratio analysis problems for ABM Module C will be from this only. So we'll study each one right now. Okay. Current ratio. See here, I've given the details. I've given the PDF also for this. Uploaded the PDF. We'll be having this again. I'm telling you, when we start the regular class, we'll be again having the same this revision along with some other numericals as well. Okay. So current ratio. Current ratio means current assets upon current liabilities. Now, what are current assets basically, and what are current liabilities? Okay. For that, what I'll do is I'll show you one first balance sheet. Many of you might have done this balance sheet in your JIB. Now you will say, sir, it's a repetition. But again, I'll tell you, the balance sheet which you'll remember from here, whatever I'll tell you, you'll remember it for throughout your life. Not only CIB, you'll remember it throughout your life. Okay. So that's why pay attention, because this balance sheet and trading and P&L, they form the basis of any ratio analysis or any banking analysis of loans actually. Remember, what do we have? We have three types of these statements basically. Actually, four statements are there. One is trading P&L, Trading basically. Second is P&L. Third is balance sheet. And fourth one which we have is this cash flow ratio, cash flow statement. So that we don't study that much because that is not asked right now. In module C, we have that cash flow statement. I'll be teaching you at that time. So right now we'll be dealing with this. We'll be dealing with this trading account, trading, then P&L, and last one is balance sheet. Okay, balance sheet. So trading and P&L are always for the year, for the year. Okay, P&L also for the year, for the year. Balance sheet is always as on. Balance sheet is never for the year. It is as on. As on date, what do I have? Trading account, I won't give you all the details what is required because those are available in your JIB books also and you have studied this. I'll just give you the format. See this. Format and the important points which are required. See this. Firstly, remember this trading account, there are two parts. One is debit, second is credit. Okay. Now in debit, remember, I'll just give you 4 or 5 names and remember those. One is opening stock, opening. Okay. Then this purchases, purchase. Then wages, wages. Okay. Opening, purchase, wages. Then what? This carriage, carriage inward and outward. Okay. So opening stock, purchases, wages, carriage inward and outward. These are the basic 4 and something fifth will be also there. So we'll study that afterwards. So opening, purchase, wages and carriage. And here closing what credit, what do we have? We have closing sales over here. And second, carry and this closing stock. Closing. Okay. Yeah. So what is this actually? Why am I giving you this? Because this will be used by you when you solve the numericals. So opening plus purchase plus wages plus carriage minus closing. This includes basically this is known as cost of goods sold, COGS. COGS. So that is equal to opening plus purchase plus wages plus carriage minus closing. This is known as cost of goods sold. You have to remember this term very sincerely and integrally. Why? Because cost of goods sold is an important term which is used in the ratios. Opening plus purchase plus wages plus carriage minus closing. So these are the basic terms which are used in trading. Now P&L, now what happens over here is in trading account, suppose if my credit side is more, means sales, I'll say, let's say it is $100, rupees, anything, let's say dollars. So sales is $100 and this expenses, opening plus purchase plus wages plus this carriage, this total is let's say $80. Okay. So this is 100, this is 80. What does it mean? My credit is more and my debit is less. So it means I'm having a gross profit, GP, gross profit, right? Now suppose it's a reverse case. This is 80 and this is 100. It means what my expenses are more. So it will be gross loss at that time. So I won't write it over here now. So gross profit. Gross profit means my credit should be more or my sales and closing should be more, whereas my expenses should be less. Now these are in trading account, always remember these are called as direct expenses. Direct. Direct means what? Which directly affect the production. Now these are generally carried out at shop floor, where the actual production is done. Shop floor. Okay. So these are all direct expenses. Now what is P&L then? Similar form we have again, debit, credit. Here I won't waste your time over here giving all the details because these are all indirect expenses. Indirect means they don't directly affect the production. Raw material is a form of trading account. Why? Because it directly affects the production. But salaries are a form of indirect, means over here. Then you'll say if this is salaries, then what are wages then? Wages are given generally to shop floor guys. Shop floor guys means those who work in actual production, blue collared jobs we call them, blue collared. Okay, blue collared. Okay, so that is blue collared, and we guys who we work in the bank as well as other offices, these are called as white collared jobs. So here we get salaries. So here all indirect expenses means what? Indirect expenses include all your printing expenses, stationery expenses, electricity bills, salaries, everything, which directly doesn't affect. Now the important expense over here, which I'll give you, is this is depreciation. This is one of the important expenses which is there in the CAIIB. Okay, CIA. So depreciation. This is an important indirect expense which is there in P&L. Now, why is this important? Because I'll tell you, there is a relationship of this depreciation in this balance sheet. Okay, the relationship of this depreciation comes in the balance sheet. Now, what do you mean by this? Say this. For that, we'll have to go to balance sheet. Before that, in this trading P&L account, what happens? Again, the same logic: credit and debit. Now, what is credit over here? It is all indirect expense. So, what is credit? Credit is always this gross profit which was there in the trading account on the debit side. That will come to the credit side. So GP will come over here. So credit is always generally one. There can be other credits also. Other credits means suppose other business some company is having, other than the main business, if company is having some other business, like in banks. Our main business is loans and deposits. But we also do the TPP income, means insurance. So that will be other income for the bank. So if you have other income, that will also come in this indirect expenses, indirect income. So that will be in P&L. Now again the same logic. If my income is more, credit is more, and my expenses are less, I'll be having net profit now. Net. This is called as net profit. And vice versa. If I'm having more expenses over here, indirect ones, and less income, then I'll be having the net loss. This gross profit is known as top line. I'll write it over here. GP means, that is, you always hear this in your CNBC channel. Top line growth. Top line. Top line means my trading account growth, trading account profit. And NP means bottom line. NP, net profit, bottom line. So these words you have to remember. Because in CIIB, you are expected to remember this top line and bottom line word. Okay? So, coming back. Correct. Yeah. Cannot see the screen. Oh, any problem? Babu Gurra, just log out and log in again. Okay. Those who cannot see the screen, kindly log out and log in again. So coming back. So now this GP, gross profit over here, now I'll rub this because this is not required in this today's study as such. So this I'll remove. Yeah. So now coming back over here. So this net profit, where will it go? Now comes the balance sheet. Now this, for your this ratio analysis, P&L is hardly of any use to you. What's useful to you is this trading account and this balance sheet. Now balance sheet will be divided into 4 parts. Always remember, balance sheet is in 4 parts. What is that? First is, here, right side we have assets, left side we have liabilities. Nowadays we have vertical form of balance sheet, right? Vertical form means what? It is just income versus expenses. So that is generally used for the service industry. But still manufacturing companies still have this horizontal form of balance sheet. This is called as horizontal form, where assets are on the right side, liabilities on the left side. Whereas in vertical form of balance sheet, what do we have? We have sources of funds, and second is uses of funds or utilization of funds. So I will just consider this horizontal one because that is very useful for you in your studies for your ratio analysis. Now assets will be again of 2 types. One is current asset and second is fixed assets. Fixed, or some books call it LTL. LTA means long-term assets. LTA, current asset or long-term asset. Okay. Now again over here, liabilities will be of two types, current liabilities and fixed liabilities, or some books call them LTL, long-term liabilities. Okay. So current liability and long-term liability. Those who are watching on YouTube, remember, kindly join this batch immediately, because this is, I'm taking it in a short right now because it's just a first class of this. So that's why we won't be able to take in details, because this is actually a two lecture series. Okay. So join the class immediately. Now again coming back, current assets over here, they are of, again they are divided into two parts. See here, this balance sheet is cross, it is divided into two parts, cross. Okay. This is current assets, and here again it is divided into two parts. Now this current assets, they'll have the two parts over here are basically, remember, all the assets given in this are current assets. Means current assets is a complete, this section, complete section is known as current assets. But what we do, we divide it into some short short part, that is called as liquid asset. Liquid asset means which can be liquidated immediately. Liquid. Okay. It is what? Cash. Always remember, cash and debtor. These are the two liquid assets. And what are the current assets? Then you have inventory. Okay. And then next is prepaid expenses. Prepaid means if I paid the electricity bill earlier, so that becomes a part of this current asset. So always remember, current asset consists of all the four parts: cash, debtor, inventory, and prepaid. So current asset includes all the four. Liquid assets include only two: cash and debtors. Inventory and prepaid expenses are not the part of current assets, liquid assets. Okay. So that's why this section is divided into two parts. One is this liquid, and this full section is known as current asset. Now again coming over here, long-term liability. Now long-term liability is divided into, I've divided it into two simple parts. That is outside liability, outside, and second is inside liability. Inside means owner's liability. Here, always remember, you had it in your JIB, the concept of what that ownership, right? What was the concept of ownership? That business is separate than the individual. So if Mukesh Ambani is running Reliance, so Mukesh Ambani is separate than Reliance. He has invested the money in this Reliance. So Reliance company has to give money to Mukesh Ambani. Mukesh Ambani is not Reliance. He is a separate identity altogether. Same logic applies over here. Okay. So in this case, let me show you, bring in one more slide. So then I'll show you, explain you something more. Hold on. So now let's go to the next page. I'll draw it better over there, explain you better over here. Now, what are these outside and inside liabilities? Let me explain you. So this outside means what? Which I take from outside, someone else. Someone else means what? It can be number one, bank. From bank, what do I take? I take, see here, we are talking of long-term liability. See this, long-term liability. From bank, what do I take as a long-term? Okay, who can answer me? From bank, what do we take as a long term? Yeah. What do we take as a long term loan? Is it term loan or is it CC? Long term loan I want. Is it term loan or is it CC? What is a long term loan in banking? Term loan, or is CC also a long term loan? Who can give me the answer? Those who are on YouTube also, you can answer. Is CC a long term loan? Important, remember, everyone. Okay, that's why I took this topic. I knew there are some of you who still feel that CC is a long-term loan. Okay, remember, CC is not a long-term loan. When I take the outside long-term liability, it means I'm talking of term loan only term loan. CC is not a long-term loan. CC is a OD, short-term loan. So CC will come over here, this current liability. So CC will come over here. Okay. So CC is a current liability, and long-term loan, this is term loan, is a long-term liability. Now this is from the bank, but I can take the loan from someone else also, long-term loan. How? Generally in corporates, we take the long-term loan from others in form of what? Bonds. bonds. Bonds means what? It is similar to FD. What is the bond? It's similar to FD. So I issue the bonds. Remember, when I issue the bonds, remember, when I issue the bond, then I'm taking the loan. It means what? What I mean by this? Suppose if the bank is giving an FD to a customer, understand this concept. If bank is giving an FD to the customer, what does it mean? It means that bank is giving a paper to that customer. What is FD? FD is just a paper, a guarantee, isn't it? From the bank. On that paper, what does the bank say? Bank says that I have taken a loan from you of, let's say, 1 lakh rupees, and I'll be giving you after 1 year or whatever that period is, an interest of 8%. So what is it actually? Bond issued. It means similar to LC issued. What FD issued. So bond is similar to FD. Only the difference is bond is negotiable. So this outside long-term liability will include two parts: bank term loan and bonds. This bonds are which are issued. Now, second part which I have told is inside liability. Inside means what? See here, why am I taking this? This is not the part of it's actually a part of your module C. It's there. You'll see all these things in module C again. Okay. But why are we taking this? Because this forms the basic, and I'll tell you, you all have done your JIB. In JIB, you had all these. But I know in JIB, what do? We just rectify the things. Learn. I always believe that learning is not important in life. You must understand the things. CAIIB is not about learning. CAIIB is about understanding. If you understand something, only then you'll be able to answer in CAIIB. If you just learn this, you won't be able to answer it. So inside liability means what? It's from the owner funds. Okay. So owner funds means what? See this business, there are two parts over here. Owner and second is business. Okay. So as I told you, Ambani and Reliance. Okay. So Ambani has given funds to Reliance to run Reliance. So Ambani has given funds. So what does it mean? Reliance is an individual person. See here, there are two types of persons in a banking, right? Natural person and artificial person. JIB again. Natural person means what? The one who is born. Artificial means what? The one who is created by paper. It can be anything. It can be HUF. It can be private limited company. It can be society. It can be trust. Anything which is created on paper is known as artificial person. So your company, limited company, it's an artificial person. So what does it mean? This person has given funds to this person as a loan. So this is a loan from Ambani to Reliance. So the Reliance has to repay the loan. When will it repay the loan? Reliance will repay the loan to Ambani when it closes down. Okay. So it's not the right thing. Any business, when it closes down, then only it gives the funds back to the owner. So that's why owner is who? Owner is basically, he has given loan to the company. Now, how does this reflect in the balance sheet? Owner's funds are reflected in three forms. Okay. One is share capital. Share capital means, what do you mean by share capital? Share capital means shares. Now, what are the types of shares? Again, JIB accounts. In share capital, we had two types of shares. Which were the two types of shares? Preference, right? Preference shares. And second was common equity, right? So these are the two types of shares, preference and common. So this preference shares is not a part of this liability. Remember, preference shares is not a part of this liability. Why? Because it is preference. Common equity is generally used over here. So net common equity shares are used in this inside liability. Because in preference shares, compulsorily dividend is to be given. And in common equity, compulsory dividend is not given. You can consider this preference also in this share capital if you want to consider in this inside liability. Basically, we don't consider, all the books don't consider this because we consider this as tier 1 capital, T1 capital. This T1 capital, you'll see this in your BFM. So one part is your share capital. Second part is your net profit. Whatever net profit the company has, That net profit, whose net profit is it? Suppose if Reliance has a net profit, some any XYZ amount. So that net profit belongs to whom? That net profit belongs to the owner, not only Ambani, all the shareholders of Reliance. That's why you get dividends. So this net profit, after paying all the taxes, it is distributed as dividends. So it is distributed as dividends to the shareholders. Okay, either as dividends, or if it is not distributed as dividends, then that amount is kept as what? That is kept as reserves and surplus, R&S. So this forms the third part of your inside liability. So again, coming back, there are three types of inside liabilities, that is share capital, net profit, and reserves and surplus. Okay, so coming back to a balance sheet format now. So outside and inside done. So outside we had two parts. One is term loan and second is this bonds. Inside we have three parts: share capital. Then next was that what? Net profit and R&S, reserves and surplus. Now what about these two? These two are simple. These two have only one, no differentiation. Okay, no two parts. So fixed asset means what? Anything which is based, which is a capital equipment. Here, we have been taught in many of our schools and colleges, or even in your JIB, you might have learned what is a fixed asset. If I ask you anyone, what is a fixed asset? All of you will answer, at least, not all, at least some of you will answer one thing, something which is can't be moved, okay, which is static, or which can be touched. Many answers are available, which can be touched, which is static. Okay, means my factory, my shed, my house, that is a fixed asset. But then I have a logic to this. If I say car, what is car? Car is basically a fixed asset. But that car is a fixed asset, but it can be moved. So where does this logic of static come? Right? So that's why static logic is gone. Then what do we say again? What is fixed asset? Fixed asset means sometimes we say which can be touched. Okay. Now, if I say if something can be touched, what do you mean? I mean something else. I'll add one more point. What is this? Trademark? Trademark. Trademark means, can you use Reliance trademark for your business? Tomorrow, if you start your own business and name it Reliance, same name, same format, Reliance will immediately put a case on you. Patent, copyright. These are all the part of fixed assets or long-term assets. Here, that's why we don't call it fixed asset. We call it long-term assets, copyright. So again, which can be touched is gone. So what is this fixed asset then? Remember, fixed asset means, or long-term asset means that asset on which, based on which I earn something, I earn something based on this. Based on the trademark of Reliance, Reliance earns. If I'm having a machinery, then based on the machinery, I earn. You might not be able to see this. I'll write it over here. If I'm having the machinery, then based on the machinery, I earn. If I'm having a factory, shed, so based on the shed, I earn. So any capital good on which I earn, okay, then it is called as this fixed asset. Okay. Now somebody has asked me what is the difference between this CC and OD. Okay, what is the difference between CC and OD? I'll give you simple logic. OD means what? Okay, there are two types of loans. Let me come back to this. There are two types of loans. Always remember, in banking, you go anywhere in banking, anywhere in the world. Anywhere in the world, you will find only two types of loans in banking. One is OD and second is term loan. Only two types. You name it anything. You name home loan, term loan. You name CC, that is OD. See here, CC is a part of OD. CC is not OD. CC is a part of OD. Gold loan. What is gold loan? Gold loan is OD. But is it a CC? No. So CC is a part of OD. Gold loan is a part of OD. Then I can have LAS, loan against shares, or loan against securities. That is again OD. Term loan, home loan, term loan, car loan, two-wheeler loan, whatever. Whichever is paid in EMIs, that is a term loan. Whichever is not paid in EMIs, where only interest is paid. So that is a OD. So OD can be various types. But one thing about OD, remember, OD is recallable. Recallable means what? I can tell any customer tomorrow morning that, see, you have been given this CC. So by tomorrow evening, you repay this CC completely to me. Completely. I can tell this guy if I've given the CC. Of course, you shouldn't tell the customer because whatever is going on, fine, is running fine. But the logic behind CC or OD is this: it is recallable anytime. But term loan, it's not recallable anytime. Suppose if you give home loan to somebody and you say tomorrow that, oh, next month you repay the entire amount of your home loan, it can't happen. This will happen only if that loan becomes NPA. If it is an NPA, then the customer has to repay. But that is the difference between OD and term loan. Okay. Now, what is this CC against stock used for working? Yeah, CC is against stock. CC is against here. There are three things basically: stock plus debtors minus creditors. That is the basic Tandon committee method we use, right? So stock, debtors, creditors. These are the three things we use. But for service industry, now look at this. We all are in a different age now. What has happened is we have learned all these things in our school life or in our JIB, like stock plus debtors. But in Infosys, where's the stock? Infosys doesn't have a stock. Debtors, they don't have debtors also. Some debtors are there, but generally they don't have debtors. Creditors, they don't have creditors. So if Infosys comes tomorrow for CC to you, you'll say no stock, no debtors, no creditors, no CC, out. So Infosys out, even the Prime Minister will come to your bank slapping you if you say out to Infosys, right? So we have to design separate ways for this service industry. Okay, so that is the point. What is the difference between this WC? Right, I think so. Yeah, I've answered this. Okay, coming back. So why have I taken this class today of this? Because to clear your basic concepts of your what all we call it, this balance sheet, term loan, everything. We just learn this, right? And we don't know many of the times. So coming back, trademark done, this shared this. Now remember one thing about the fixed assets. The something which is to be remembered about the fixed assets is the basic thing based on which I earn. Now I'll tell you one simple logic behind this car also. Car is called as fixed assets. Okay. So car for me is a fixed asset, but the car company which is selling the car, is it a fixed asset for them? No, it's a current asset for them because it's their business. So again, remember, current asset and fixed asset, there is not a static or a static thing. They are dynamic. What is the use for flat? Let's say we say flat. Flat is a fixed asset for you, but the flat for the builder or the developer is a current asset. So based on the use, computer we take it as fixed asset, but computer for the computer dealer or seller is a current asset, isn't it? So that's why it depends on the use. Now, what is this about the current liabilities? We have CC, then OD CC we call it one only generally. Then we have what? Payables. Generally we call that payables, and we call them creditors also. Creditors. Okay, creditors. Then we have EMIs. EMI is also, see here, term loan is a long-term asset, a long-term liability, but EMI is a current liability. The EMI for the term loan is a current liability. So coming back over here, now enough of this balance sheet. Almost everything is clarified to you guys, okay? This slide, if you keep it throughout your life and follow this video again and again, you will never go wrong in the ratio analysis. You will never go wrong in this balance sheet trading and these concepts of these, okay? So coming back, current ratio is what? Current assets. Now current assets, I've already told you all the four things. Just type it in the comment section. What are the current assets? Cash, debtors, inventory, prepaid. Current liabilities, all that OD, CC, whatever is to be given immediately, right? So that becomes a part of this current liability, right? The current, here I've given here also inventory, debtors, cash, prepaid, etc. Current liability, creditors, bank, CC, OD, term loan, etc. EMI. Okay. Liquid ratio. Liquid ratio means liquid assets upon current liabilities. What are liquid assets? Just now we saw cash and debtors. See this, debtors and cash. Then what is that? Next one is that current liabilities, right? Current liabilities remain the same. DSCR. Here we had this current ratio and this DSCR in this current this short term right. So 4 year. This DSCR we had it in the short term solvency. So coming back over here, DSCR means debt service coverage ratio. Always remember DSCR is what? Ability to service the installment, means whether that customer has the ability to pay the loan. Okay. So EMI for the next year. So what is the formula for that? Net profit before tax plus depreciation plus interest on long-term debt. The whole upon, see, this is the whole upon. This is like this. Let me make it red, okay? Because this is a white screen. Hold on. Yeah. So this is net profit plus depreciation plus interest on long-term debt, the whole upon. Again, look at the denominator. Total EMI for the year, your bank plus other bank, plus interest on long-term debt. So this interest on long-term debt comes two times. In the numerator also, in the denominator also. ICR, interest coverage ratio. This is used only for CC. DSCR is used for term loan. This is used for term loan. And ICR is used for CC, cash credit or OD, any. Okay. So interest coverage ratio. So it is what? EBIT, earning before interest and taxation, upon interest on long-term debt. So this is basically ICR. Now debt equity ratio. Debt equity ratio means long-term debt upon total equity. Now what is this long-term debt? Long-term debt will be of two types, outside and inside. Outside and inside. Okay. So inside, I've already clarified what is outside, bonds and term loan. Inside is what? All those three, right? Net profit and all this, what? Share capital. And third one was reserves and surplus. FA ratio, fixed assets. So fixed assets upon long-term funds. So long-term funds over here means outside as well as inside, both. So here it means it includes both outside and inside. And here, see here, this part I'll just clarify over here. This inside comes over here in debt equity ratio and outside comes over here. Means bank loan, term loan and this what bonds, they come over here. Term loan and bonds, they come over here. And the remaining three, they come over here in the denominator. That is for debt equity. And fixed asset ratios, fixed assets upon long term. Here both of them come. Outside and inside, both of them are combined over here. Out and inside. And fixed assets means fixed asset is the right side. Okay. This fixed asset, we saw it in the balance sheet over here, right? This part, this complete fixed assets part. Okay. Now, before leaving today, because here we won't be able to complete, as I told you, you guys also, those who are watching on YouTube also, this is not a single lecture series. Single lecture, it can't be done. So tomorrow again, I'll be continuing with the same topics with the ratios now. Today I explained you the balance sheet term loan. Tomorrow the ratios will be simple. We'll be doing this. Now, let me explain you one important concept over here. That is EBIT. You always hear this word EBIT over here. EBIT this, EBIT that. But what is this EBIT? Okay. You need to clarify these concepts over here. Let me clarify this. EBIT. So this over here. See this. EBIT means here, whenever you see, you follow anything, means as I gave you these balance sheets, look at this, these balance sheets, okay? What did I give you? We come to gross profit over here. From gross profit, we come to net profit. From net profit, it moves to balance sheet. See this, net profit over here. Where does this net profit go actually? This net profit will go over here, inside liability. Where will this gross profit go? This gross profit will go over here. So these terms are important now from this point. Say this. Whenever I move from trading account, trading. So what do I get? I get GP, gross profit. So that gross profit is moved where? It is moved to P&L. Okay. Now in P&L, there are various types of profits. So what are those various types of profits here? First one becomes operating profit. Operating. Okay. Operating profit. Operating profit means what? All the gross profit which I am having, when I subtract the operating expenses. Now, what are operating expenses? Operating expenses means all my electricity, salary, everything which comes in my P&L. So that those operating expenses, when I subtract it from my gross profit, I get operating profit. Okay, operating profit. Now this operating profit, again there are parts in this. Okay, we get earning from operating profit, we get EBIT, earning before interest and taxation. EBIT. How do I get EBIT over here? From operating profit, what will I do? I'll subtract depreciation over here. Depreciation. Okay. And then I'll subtract this amortization. Amortization. Okay. What is this then? Depreciation and amortization. So before this operating profit, we'll come to one more profit that is called as EBITDA. We always hear these words: EBITDA, EBITDA, earning before interest, taxation, depreciation, and amortization. Earning before interest, taxation, depreciation, and amortization. When I subtract this depreciation and amortization from this, when I subtract this, I get this EBIT. Generally, what happens? Operating profit we always equate it to EBIT. Generally, okay. First is EBITDA. From EBITDA, I subtract this depreciation and amortization. I get EBIT. So this EBIT is also called as operating profit because depreciation and amortization are not the part of this operating profit. Operating means what? On a daily basis, what I am using. From this EBIT, what happens? I'll subtract this interest first. Interest means what? Interest to be paid. Suppose if I've taken a term loan or a CC, then interest will be paid. Then after that, I'll subtract the taxes. So from these taxes, when I subtract, I get the remaining thing which I get, that is called as NPAT, net profit after tax. NPAT. So what is the sequence now? Gross profit, then EBITDA. From that EBIT is also called as operating profit. From EBIT, we get NPAT. Now, what do we do with this NPAT? This net profit after tax will be done what? That has two ways now. One way is dividend. This net profit after tax is given as dividend to the shareholders. Either this, or if it is not given as dividend, then what does it happen? It moves to reserves and surplus. Okay. So remember, there are many companies who don't give dividend. For example, Reliance. Reliance hardly gives any dividend. Hardly. Reliance never gives any dividend. What does it do? Whatever profit it gets, it invests in this as reserves and surplus. And there are many companies who give, who Reliance is does not give. I'll write it over here. Does not give dividend. So every penny of this Reliance goes to R&S. Whereas there are many companies who give dividend also, like Tata companies, many of the Tata companies, as well as many of the oil companies, HPCL, BPCL, all these, Vedanta, these companies, these are all dividend paying companies. So it is either shifted to dividend or it is shifted to reserves and surplus. Okay. So this is a journey of actually profits, gross profit to EBITDA, EBITDA to EBIT, EBIT to NPAT, and NPAT to either dividend or reserves and surplus. Okay. So those who are watching on YouTube, yeah, what is amortization? Okay, that is also a good question. What is amortization? Amortization means what is a term loan? Tell me. We take a home loan, isn't it? Whenever we take a home loan, we always get a sheet. Now, if you take it from some private banks give you a sheet. That sheet contains what? That sheet contains that EMI schedule. EMI schedule means I am giving you 1 lakh rupees right now as a loan. So you'll have to pay this in, let's say, what, 10 years. So 10 years per month, your EMI will be this much per month. This is for January, this is for February, each year it goes on and on up to 10 years. They'll give you the EMI. That they'll give you the breakup also in this EMI. See, in the initial years, your interest will be more, and then in the later years, your principal will be more. So this schedule, which gives the EMI and the breakup of this interest and the principal part for the full loan, is known as amortization schedule. And what is amortization? Amortization means converting a one stroke money or one time money into EMIs, or vice versa. What is RD? RD is reverse of loan. RD means what? I put some money in the bank every month, whatever the period is, right? And in the end, I get one stroke some amount. Whereas what is a loan? Loan is the reverse of RD. Here, what do I do in loan? Oh, first, I'll give the money to somebody. Means bank will give the money to somebody, and then I'll get it in the EMIs. So that is amortization. Okay. So we'll stop here today. Okay, because this lecture was basically to clarify our minds, not doubts, minds about balance sheet, this P&L, your this what trading account, then what are these? What is this profits, EBITDA, and all this? You might have heard these names, but what happens? We only hear, we don't know. much about this. Okay, so that's why I'll always prefer. Okay, those who are watching on YouTube, kindly I would suggest to join the batch ASAP, because right now we have not started the main topic as of now. The main topic will be started after this foundation batches are over. Okay, tomorrow also I think so the foundation batch will be there, but afterwards we'll be starting with the this complete main topic. Okay, so then we'll be moving fast and the important parts will start over here. So how to join this? Click on JIB and CIB. Click on this CIB November 23. Okay, then click on this Sankalp batch, CIB Sankalp batch. If you're having the app, go through the app. I would always suggest. Okay, then you'll see the details. All the details you can read it. Just click on buy now. See this code. There are two codes. July 75 also there. Plus right now ME80 code is going on. ME80. Okay, click on apply. See this 80% off is going on. So ME80. This code won't last long. Okay, take maximum benefit of this 80% discount. So 23,999 reduces to 4,799. Such a huge discount. Go for it. Okay. So I'd always urge you to join the batch ASAP. Okay. Amortization given. Yeah, given. So I'll always urge you to join the batch ASAP, because CAIB is not as simple as JIB. If JIB portion was 10%, means let's say I'll count it in rupees. If JIB was 100 rupees, CIB is at least 1000 rupees, 10 times more portion than JAIB. Okay. Chalo, bye from my side. Hope so. Your doubts are clarified over here regarding trading account, balance sheet, P&L, EBITDA, EBIT. Okay. Chalo, bye from my side.